Hello, Dividend King subscribers. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And this week's FastGraphs Friday Analyze Out Loud video is going to take a look at Enterprise Products Partners, a limited partnership that does produce a K-1. And the real question here is, what I'm about to show you actually worth the nuisance of taking a K-1? So let's go ahead and get into the video, if you will. I want to start by pointing out that Enterprise Products Partners is actually one of our top buy list companies, and this is our top buy list off the Dividend Kings. I want you to see how it compares. Now, it is in energy, but it's an energy storage and as well as a pipeline company, so it's not really directly tied to oil prices like some companies are. It can actually make money in different kinds of energy environments. We have it ranked as a potential good buy. I'm going to rank it much higher than that personally. I want you to see how it compares to the 64 companies on our top buy list. The average quality score of these 64 is 10. Enterprise Product Partners, I'll call it EPD from now on, is 12. The average dividend score of these 64 companies is 4.43 out of 5. Of course, Enterprise Products has a dividend safety score of 5. The average dividend growth streak is 18.33 years. Enterprise Products, or EPD, has a streak of 23 years. It's on its way really to dividend champion status very soon. The average company on our list has a discount to fair value of about 12%. Enterprise Partner is 37%. I think it might actually be a little higher than that. And then the average dividend yield of our top buy list is 3.41%. But in the case of Enterprise Product Partners, it's 8.33%. So let's go ahead and look at this stock. And there's some very interesting aspects of this company. To me, a limited partnership like this is all about the income. So the income, of course, is paid from the cash flow. So when I'm valuing a business like this, I like to look at it from a standpoint of operating cash flows. And as you can see here, the dividend is well covered by operating cash flows. And again, this is about an 18 to 20 year view here. The company's increased its dividend for 23 consecutive years. The average growth of the dividend has been about 6.7%. The compound average growth has been 6.67%. But as I said a minute ago, this is all about the dividend. Now, the average yield, if you'd have bought this stock in December of 2001, 12/29/2000 actually, your yield that then would have been 7.4. It's currently 8.33. But I want you to look at your yield on cost or your growth yield. Because the company did increase the dividend every year, that yield on cost rapidly grew. Last year alone, your yield on cost would have been over 22%, but that's not really what's phenomenal in my opinion. This company would have turned 10,000 into 27,000, which is basically a dead heat with the market, maybe slightly underperformed the market on capital appreciation. But look at the cumulative dividends. This company would have given you back just almost 3 times your original investment in dividends alone. And with the S&P 500 or buying the average company, you'd have got less than half of your original investment back. So let's look at this. Let's look at it from a different aspect. The cash flows here are good. We can see the white line here is the dividend line. You can see that it's had a really good streak in dividend income. But there's something I like to do. And by the way, before I leave this, I want to make a point. The price to cash flow ratio for this company is 7.41. Right, the normal priced operating cash flow for this company has been 11.38. That's really where the discount is. So, I do agree with what you saw on the buy list. The discount to fair value, the Dividend Kings on this list calls it 37%. I think it's over 50%. My own view. Now, you can measure this a lot of different ways, but I'm based on an operating cash flow. But as I said, this is all about the dividend. There's something I do unique to help me gauge when is a good time to buy or sell a master limited partnership, because the majority of them are all about the dividend income. I go ahead and take the normal PE off, and I go ahead and take the operating cash flow off. And when I look at this company is from a valuation perspective, is how am I valuing this stock relative to its dividend? And you can see the price tracks the dividend. And when the price gets below the dividend, which is this, it's actually a honeydew green line. It looks white when the graph is put together. You can see low valuations are a great time to buy the stock. If it's trading on the dividend line, it's a good time to buy the stock. And if you can catch it like you do now, significantly below the dividend line, it's really an awesome time to buy the stock because now you've got leverage. And I want to talk about that a little bit. From a forecasting point of view, we're not expecting any growth. In fact, it might even have negative growth over the next couple of years. However, even a no growth or negative growth company is worth a multiple of earnings. So even if this stock stayed at its current PE multiple of around 7, we can point out here and see that this stock would generate almost a 6% rate of return, most of that coming from the dividend. If it moves back to its normal PE, it's a 31.5% annualized rate of return. I'm using the normal multiple fast graph here to make those determinations. So what I'm really talking about is what I call the natural leverage of this company. There's no reason why it should not go back to a more normal PE of 10 or 11. It's traded at that historically many times, and many times it's traded above that. That's the blue line on this particular graph. When I'm looking at forecasts here, I can use this handy drop down, and these are all the historical multiples of cash flow that the company has sold at, traded at historically over the last 20 years. And you can see the most recent is the lowest, which is the 1 year has been 9.04. It's currently trading at 7.41. So it's actually below its lowest on history. There's another way to value these MLPs. Let's go ahead and bring the historical dividend yield line, and I referenced this in the written portion. This line shows the year-end dividend yield at different valuation levels. Now you can see when the price got below the white line here, if you will, it looks, clearly looks white when the graphs are put together. We had a price to operating cash flow of 5.79. That's the lowest it's ever traded at least over the last 2 decades. And it would correspond to that. If you'd have bought it then, you'd have had a dividend yield of 9.86. So that's been the highest. But today's current dividend yield of 8.33%, as you can clearly see from this graphic, is the second highest dividend yield this company has offered. So if I drop this to about a 14-year graph here, and look at it from a standpoint of its highest dividend yield ever, and go ahead and look at performance, you can see that even since calendar year 2008, December 31st, 2008, or the beginning of 2009, this company generated 3.5 to 4 times as much dividend income as the market, but it did not produce the capital appreciation. This was a historic time for the stock market. And, so the point is, this isn't typically about capital appreciation. What this is typically about is the dividend income, and I really want to make that clear. Now, other ways that I like to measure this, I like to look at things like EBITDA, which is another form of cash flow, and look how the company stacks up on EBITDA. Once again, it's trading at a blended price to EBITDA of 5.9, normal price to EBITDA of about 10.05, which in this case on the EBITDA graph, it's the orange line. So you can see we have a significant amount of natural leverage here. We have the ability for this stock to go back to that normal price to EBITDA of 10 and generate, 35% annualized rate of return over the next year or two. And, we saw the same thing with operating cash flow. I look at the normal numbers here. I've got potential total returns in the 28 to 35% range over the next 2 or 3 years. I've got an 8.33% dividend yield. I've got a BBB plus rated company, which is very high by MLP standards, has moderate debt at 52%, long-term debt, but the real key is it has a long streak of raising the dividend, and this is the second highest yield you could have ever bought this company at. I believe this one is worth the K-1. The K-1 is a nuisance. I hate them just like all other investors do. But, maybe if I spend a few shekels to, hire a CPA to file it for me or just go ahead and file it myself, to get an 8.33% yield with capital appreciation in probably one of the safest stocks on the Dividend Kings list, I think it's worth a closer look. So any of you who are looking for high yield and high income with safety, you might want to take a closer look at Enterprise Products Partners. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this video. If you liked it, go ahead and subscribe to our YouTube channel. Give me a like and ring the bell. Thanks again for watching.